for more on the final jobs report of 2016, what it means for the Federal Reserve and monetary policy, and we care about that, we go to Peter Barnes in Chicago. He has an exclusive interview with Cleveland Fed President Loretta Mester. Good to see you, Peter.
Hi, good morning, Dagen. That's right. Loretta Mester is joining us now this morning to talk about the economy and monetary policy going forward. Welcome back to Fox Business, Loretta.
Thanks. A pleasure to be here.
Let's get right to these jobs numbers. You're an economist. 156,000 for December. The unemployment rate ticking back up to 4.7. What do you think of that, and what do you think it means for Fed policy going forward?
So that's a very decent report, in line with what we've been seeing. My own view is that we're basically at full employment from the point of view of the monetary policy goal, one of our dual mandate goals, and I find that in line with sort of the economy on a good track, continue to improve in labor markets, adding jobs. We talked about the distribution across different sectors, and it's in line with what expectations would be, my expectations would be.
So you and your colleagues raised the Fed funds rate, their benchmark rate, a quarter point in December, and your new forecast for 2017 shows an increase in the number of rates penciled in for 2017 to 3 from rate increases in September. Are you comfortable with that? Is that what your forecast is, and why was there that increase?
Right. So that's a reasonable, number. I mean, it's not that much different from what the September forecast would be. I've been a little more seeing a little more strength in the economy. I have a little more built-in inflation pressures in my forecast. So, I'm probably a little steeper than that in my forecast. But I think the median path is a good summary of kind of where the tenor of the committee is. But of course, as you said, pencil in is a good word in the sense that, we're going to react. We didn't have a lot of information about what the fiscal package will be going forward. I expect that we're going to see some more information about that as, the months go on, and, we're going to be changing our forecast. I wouldn't be surprised if our forecast will be more variable this year, just because we're going to incorporate as more information comes out about what those fiscal packages will look like in terms of tax policy and other policies that the new administration is promulgating.
Yeah, and that seems to be the X factor in going forward for policy, because according to the minutes of the December meeting released on Wednesday, you and your colleagues appear to have spent a lot of time talking about the election results and the potential fiscal and stimulus policies that might be coming out of the new administration. How heavy was that discussion, and what does that mean for policy going forward?
Yeah, the minutes are very reflective of how our meetings go. I mean, certainly, we were presenting new forecasts, the SEP round, and so we had to talk about whether we incorporated fiscal policy into those forecasts. And as the minutes reflected, some of us did and some of us didn't. I had a little bit stimulative fiscal policy in my forecast, but certainly I expect to change that over time as we get more information about it. We just don't have a lot of information on what those policies are going to look like in terms of tax policies and other. I did not incorporate anything on immigration policy or these longer run policies that could also affect the economic outlook. So again, I think that we're going to, as we go through the year and get more information, we're going to be changing our forecast to reflect that, to the extent that those kind of policies affect our dual mandate goals and our achievement of our goals. So the Fed is going to be continuing to focus on our dual mandate, right? Price stability, full employment, and obviously fiscal policy plays into the outlook, and we're going to take that on board, as we will other kinds of things going on across the global economy that impact the U.S. economy.
It sounds like your biggest concern is inflation. That inflation pressures. It sounds like you're a little bit more optimistic about the economy this year, and for you that the big risk in the forecast is with inflation. You're more concerned about that.
So I wouldn't call it a big risk. What I would say is that I think that over the next 2 years we're going to meet our inflation goal, and as you know, of 2%. And as you know. And I also think that we're basically at full employment, so in that sense we've met that part of the mandate. And as you know, monetary policy has to be forward-looking. So, what we're trying to do is sustain the expansion. right? And we sustain the expansion by focusing on our goals, and we're going to be moving policy in order to try to achieve that and to keep the expansion going.
But it sounds like you said that your forecast incorporates perhaps more rate increases for 2017 than your colleagues. Are you at potentially 4 or 2017?
Well, it's not that productive to count number of things. The key thing is that if you look at the median path in the SEP, it's an upward sloping path.
Right.
And, mine's probably a little steeper just because I have a little more optimism in terms of meeting the inflation goal, probably a little bit strength in my growth forecast. I see us basically at or a little bit above 2%, which is my long-run forecast, which is a little bit higher than the median in the SEP in terms of long-run growth. But again, these kinds of little deviations across the participants really aren't that large when you think about the uncertainty bands around this kind of forecast. So again, if you look at the median in the SEP, I think that's a very good benchmark forecast for what the committee is thinking.